We got a whole team here with us for coverage right now. Our all-star Fed panel. I'm here with Jay Pulaski on set. We have Liz Klayman down at the NYSE. We have Kimberly Foss. We have Art Laffer, and we have Brian Westbury. I'm going to go first over to Brian. Your thoughts on this? We anticipated a quarter-point hike. It happened, right. But of course the big question now is what comes next.
Yeah, I'm not surprised at all. I knew 2 rate hikes next year wasn't enough. They're going to go 3. We've got rising wages. We've got falling unemployment. We have rising inflation. The Fed is behind the curve. They're going to catch up. So that's what this said today.
All right. Isn't that sort of the way it always goes, Jay Pulaski? The Fed is typically behind the curve. They're always playing catch up. The question is, can they catch up fast enough? In other words, we've started to see some positive signs in this economy. And if Donald Trump is successful with his economic policy, it could mean lower tax cuts, less regulation, therefore even better things for this market and for the economy. Your thoughts?
Well, I think maybe better for the economy, Trish, but I'm not sure better for the markets, because if that's the case, then I think the market will worry about the Fed being behind the curve. You'll see the return of the bond vigilantes. Remember them from the 1990s? The risk of sharply higher rates on the long end, which could lead to a weaker economy, a weak stock market, and kind of the cap on the Trump economic plan could well come from the markets and the fear that the Fed is behind the curve, inflation is spiking, higher rates, stronger dollar, weaker economy, weaker stock market.
You know, this is significant, Kimberly Foss, in that they are raising the range here to half point to 3/4 of a point. What does that say to you?
Oh, I think it's baked in there now that, you know, they have stronger economy and unemployment's under control. And so that's going to be an expansion. Plus, with Trump's ideas of maybe, you know, spending more on infrastructure, tax cuts, both personally and federally, as well as, sorry?
No, I'm agreeing with you. I said, keep going.
Oh, yeah, and as well as, you know, regulation reform. I think this is a great environment for investors for the long term. Yes, it's going to be volatile in the short term, absolutely, because as interest rates rise, you know, it's a transition time, and we haven't seen this in a long time. So
let me jump in for a second. I want to bring Art Laffer into the conversation as well. We haven't seen this in a long time. I mean, they did raise once, but, you know, it had been basically years and years, I think going back to, you know, 06 or so, where you really hadn't been in an interest rate rising environment. A lot of people, Art Laffer, had said the Fed basically lost its mojo, that it was completely irrelevant. Is there a chance now that they may be gaining some relevance in a way that they have not seen for perhaps a decade?
Well, I don't really think they will be gaining relevance, but I hope they don't. I hope they don't gain relevance, to be honest with you.
Well,
but if
let me explain
correctly,
what I'm saying first of all, because part of the problem, right, Art, with the Fed was they'd say, we're going to raise, we're going to watch these economic conditions. They seem to be improving. We're probably going to raise. And then guess what? They didn't raise. And that was basically a problem of sort of not following through, it seemed as though, on your word. And they were consistently behind, as, you know, Brian Westbury points out yet again. They're sort of behind on this one. But do they have a chance to play some catch up?
Well, I don't know if they do or not, but they shouldn't be watching rates. The markets will do a very good job of watching rates for themselves, to be honest. If we're going to have a boom, which I think we will, the real yield has to be somewhere between 2.5% and 4.5%. Because remember, the real yield is the expected real return on a unit of capital over the next 10 years, if it's a 10-year real yield. If you're looking at that with a 2% inflation, I would expect the 10-year bond yield to be somewhere between 4.5% and 6.5% in the next year and a half.
Wow.
That's where it should be. That's what really needs to be there for a boom.
Jay's shaking his head. If that happens, what?
If that happens, stocks go down big. Stocks cannot handle rates anywhere near that level.
The opposite, just the opposite, because it's the expected real return on capital that will be rising, the TIPS yield. And the TIPS yield is the expected return. So as stocks become more profitable, corporate tax rate reduction and all of that, I think you're going to see the real yields rise, which is very good for stock prices.
Let me go over to Liz Klayman at the NYSE. And Liz, you know, I'll tell you one sector that certainly likes these higher rates. That's financials. Bank stocks benefiting here, as we have seen in recent weeks, not just from Donald Trump going into the White House, but from this expectation that we will be in a higher interest rate environment.
That's
Liz.
Always good for banks, right? At least on the retail side. Trish, for a second there, we were off to the races. We were about 19,951, 52. Right now we're at 19,938, but we're certainly closer than we have been in quite some time, or perhaps ever, to Dow 20,000. You know, first it was a collective, you know, this is what we expected. And then suddenly, about 2.5 minutes ago, I believe while Art Laffer was talking, so you can credit Art, we started to spike up here. We're losing it now. This is a living, breathing thing. We're now up only 2 points. We may turn negative here for the Dow Jones Industrials. Russell and S&P are down, but pretty much flat. Trish, I've got to figure it's because people are waiting on what comes at 2:30 p.m. Eastern in about 19 minutes or so, 14 minutes when Janet Yellen comes out for a press conference. You've got to hear that statement. Most importantly, what you just said, how will Donald Trump's policies affect things like inflation and growth?
Right. No, and that's what people really want to know. Peter Barnes is still standing by there in the Fed lockup room, no longer locked up. 4.5% is what they're anticipating by the end of 2017 on the employment rate. Give us some more details about what we heard today.
Yeah, the economic forecast did not change much, but they do see unemployment going to 4.5%, Trish, as you said, which to them is probably pretty close to what they call full employment, despite all the problems with that number and part-time workers and all the people dropped out of it, out of the workforce. They see the economy getting to their full employment target, and they say they see inflation getting closer to the 2% target. And they note here in the statement on the economic analysis that market expectations for inflation have, quote, moved up considerably. So that may be one reason why we see them looking at 3 rate hikes in 2017 instead of 2.
Brian Westbury, we're up, what, better than 8.5%? It's just since Donald Trump was elected, so clearly there's more optimism out there in the markets overall. Why does the Fed want to temper that so much?
Well, I don't think they want to temper it. Remember, they're behind the curve. So raising rates even 3 times in 2017, all it does is make them less loose. It doesn't make them tight. Rates are still so far below normal that the Fed can raise rates 5 or 6 times from here at a quarter-point increment and still not be tight. And there's one other thing I want to point to here, and that is that even though the Fed raised rates today, they didn't actually tighten monetary policy. There are $2.2 trillion of excess reserves in the banking system, and the Fed didn't touch them. There's not one dime less now after they raised rates than there was before.
Okay, so how does this affect how you're thinking? Go ahead.
Can turn into inflation. All I'm saying is that money can turn into inflation. So they can do whatever they want with rates until they get rid of those excess reserves. They aren't actually tightening the economy. Not at all.
Yeah, but the market will tighten for you, and that's what's happening. Rates have backed up considerably, and you have mortgages that are becoming more expensive.
But I guess it's the pace of it too, right, Brian? I mean, if you suddenly went to 6% overnight, but we're not looking at that. I mean, if you're just gradually moving higher, then one would think it gives enough breathing room for the economy to grow, for the markets to continue powering higher, and then yes, interest rates move higher, but in a sort of gradual. In a gradual move. I mean, it's not like you wake up tomorrow and you're suddenly at 6%.
But the risk, Trish, is that...
Hang on to Brian and then to Jay.
This is where I'll agree with Art directly. We're going to have a better set of policies, lower tax rates, less regulation. I pray, less spending. And if we can do that, we're going to have a Reagan-type boom. And with that boom comes higher real growth, comes higher rates that aren't bad for the economy.
Yeah, it seems like a pretty good setup, but Jay's exercising this voice of caution here. So explain to us your scenario, because I like what Brian's saying.
Sure. Well, I mean, I like it too. If it were to happen, that would be great. And I think there is a window for it. It's a narrow, as I call it, a narrow policy path, Trish, between kind of an overheating economy, too much spending, too much tax cuts, too big an infrastructure program. Bond vigilantes get into the long end of the bond market, send rates up sharply, and you have a stock market correction and an economic correction. On the other hand, is the risk of kind of an unexciting Trump presidency where the first 100 days don't go well and where there's a lot of expectation built into the stock market. For example, hedge funds exposure to financials, which you just talked about, at a 13-year high. The market has moved aggressively in anticipation of successful
But isn't it also that people were covering their previous positions? In other words, they were short things like financials, Liz Clayman,
Right.
because they anticipated that Elizabeth Warren would really be making herself heard. Via Clinton's administration, there would be much more regulation. They were long things like technology, the Facebooks of the world, which now are, we got the tech meeting today there over at Trump Tower. Donald Trump is going to say, listen, guys, you need to have a more active role in policing the communication between ISIS members online. And so all of a sudden, the portfolio that they thought was set up for a Clinton administration wasn't there. And so they've had to go out and buy financials aggressively so. Isn't that fair, Liz?
Well, yeah, the portfolios for either one. Some people absolutely thought that everything was going to go down. So I heard a few selective groans on the floor around here because, I'm short. And again, the number to beat now, Dow up 55. Right now it's up 24, but that's where it surged right after the Janet Yellen announcement. Let's call it 2 or 3 minutes after the Janet Yellen announcement. Look, the Dow is putting that aside, because 20,000 is really just a number, Trish. The Fed is saying the near-term risks are balanced. The Fed never gets too excited about these things, but it's not a surprise that we're starting to inch closer and closer to that almighty Dow 20,000 mark. But I am watching gold. Gold was up slightly, and now it's down. So we've got crude down, gold down. The VIX is pretty much flat. There's not a lot of movement because, as I keep saying, imminent. Janet Yellen's comments are imminent. You know the reporters are going to get in there, including Peter Barnes, and they're going to ask the really tough questions about, is it 3 hikes? What if we need 4? What if we start to see inflation really
And one would
kind of
also anticipate, Liz, that they're going to ask some questions about what she expects from Donald Trump in the way of his economic policy and what's that going to mean for the overall economy. Art Laffer, what do you think she'll say, if anything, about Donald Trump?
Well, I don't really know. I don't think she likes Donald Trump, just guessing, by the way. But what I do think is really important.
He doesn't really seem to like her so much either.
Well,
the feeling might be mutual.
I can understand that. I don't know why she doesn't like him. I do know why he doesn't like her, but that's just a taste issue. But Brian Westbury's comment was really serious when he talks about excess reserves. There is nothing in the monetary system that is sitting there that's going to stop an expansion in the U.S. economy. As long as we have excess reserves like that, there is no way that the monetary system can be pulled back enough to stop an expansion. And there's no way she's going to reduce that monetary base, the excess reserves, back down to where they should be, which is equal to required reserves.
All right, Kimberly Foss. Let's look at the silver lining here. As much as Jay's worried about rising interest rates, there is a group of people out there that benefits significantly from this, and it's retirees, right? You've dealt with a lot of them there in your financial planning business. How are they feeling about interest rates right now?
Well, they love this. This is joyous, jubilation right now to my thriving retirees. They love the fact that, interest rates may rise because on their fixed income, they're going to get a little bit more income off their dividends and their interest, and that's a good thing. They do have to temper that. And I think, too, Art and Dave's comment, it's the trajectory and the velocity in which the Feds raise rates in the coming year or 2 years, in which will affect my clients and investors' portfolios out there. And that's where you have to be proactive and balanced in your portfolios, I believe.
Go ahead, Jay.
No, I would just say that I think we need to keep in mind that what really controls long-term rates, which is what the mortgage market, the auto loan market, et cetera, work off of, is the investor base, not the Fed, the investor base. And I'm worried that the investors will look at this and see if the Trump plan goes full bore, as I call it, and you have a big tax cut and you have a big infrastructure plan, I think people are going to get worried that the Fed is behind the curve, even if they do plan to raise rates 3 times, and send long-term rates up sharply.
I want to go back to Art on that very issue, because it makes sense, right? You're going to do all this spending. You're going to also, in the way of a tax cut, offer more in the way of spending. But, I think Art would differ in this, in that you feel very strongly, Art, that you've got to grow the economy somehow, right? And sometimes you got to spend a little, and you got to cut taxes a little in order to generate that growth. And so the hope is you get enough growth, you can actually increase your base, and you're bringing in more in the way of taxes, and hopefully it all evens out. It's a tightrope for sure, but Jay's worried about it going south. What say you?
I'm not worried about it's going south. There's no amount of tax cuts that's too much. In this base today, you've got to get economic growth.
That's a good, Art Laffer, there is no amount of tax cuts that is too much. I love it.
I'll take the other side of that.
Well, that's fine. You can have 100% taxes if you want. I've never heard of an economy, Trish. Now, maybe I'm wrong on this in Econ 1, but I've never heard of an economy taxed into prosperity. Nor have I ever heard of an economy where poor people can spend themselves into wealth. And you know what you've got in the traditional Obama is tax increases and stimulus spending. That's the clear-cut formula for a disaster. Just reverse Obama, and we'll do it really well.
I mean, we
Reagan,
saw it. Yeah. 8 years of it. 1.8% annual growth on average. That's pretty lousy. Considering where we were, we should have seen a big jump up.
Isn't it wonderful? We had no inflation and low interest rates. Not.
Go ahead. I think Brian Westbury's trying to get in. Go ahead.
Yeah,
sir.
and to put these two things together, interest rates and economic growth go together. The
Yes, they
more
do.
likely economic growth is going to be stronger, the higher interest rates will be.
Thank you,
we call
Brian.
it the real rate of return. And then if you want to add inflation on top of that, then that's another reason for rates. So higher rates don't necessarily mean bad things. In fact, they actually mean good things most of the time.
Yeah,
But
you know, because if you have higher rates,
Yes.
you're in a better economic environment. And so it should spell good things. And certainly
Right.
for financials. I want to get back to Liz Clayman for a moment as we watch these markets here. And everybody's waiting to hear what Janet Yellen is going to have to say. That's happening at 2:30. So stay tuned any minute now. Janet Yellen is going to take to the podium and address reporters' questions. You know, Liz, we've been living sometimes, it seems, in this Alice in Wonderland upside-down world where bad news on the economy is actually good for the markets because people feel that the Fed will not be proactive in terms of trying to raise rates. Could there be a chance now where we have a chance at normalization in that, you know, if the economy is doing well and rates are going up, as Brian says, you know, it's all good?
Well, yeah, but look what we see now. The Dow is now down about 12 points. So the low of the session, we were down 48, Trish. Listen, some of this is just sell on the news. And then some of it is that indecisiveness in advance of what is now about 12 minutes away, and that would be Janet Yellen's comments. So as we wait on that, there are a couple things happening there. People need to look at treasuries. Right now, 10-year yields are spiking. That means fears coming out of the market, and people are thinking, why should I go in there? I should go into equities at the moment, even though we're not really seeing that reflected this second into equities. But
let me jump in for a moment, Liz, because you can't see this, but the viewer can. Donald Trump right now is meeting with tech executives there at Trump Tower. He's talking to quite a vast array there of folks, big deals in the tech community. And this is a kind of tech summit that he's holding. Of course, his relationship with the tech community has not been considered ideal. Peter Thiel, of course, was the big backer of Donald Trump. He was kind of the lone wolf, if you would, out there in Silicon Valley, campaigning actively for Donald Trump and saying that these are the policies we need to get our economy going again. Brian Westbury, there has been a pushback, if you would, from that community. But, you know, look, he's going to be the president. Do you anticipate that they're going to come more into the fold, that they're going to have to? They don't have a choice.
Yeah. They're going to come into the fold. And by the way, tax cuts are good for them. Bringing back money from overseas is great for them. So they're going to come into the fold because the policies that Trump has talked about are going to be great for them over time. But I want to make one quick point. I'm not saying that what we're doing, talking about the Fed, isn't very, very important. But what I would say is that Americans really shouldn't even know who the chairman of the Federal Reserve is. All right, I'm deadly serious about this. We focus way too much. They're not the ones who create wealth. The ones in that room with Donald Trump, those are the entrepreneurs who create wealth.
Yeah, and
so
let me just
what's
also jump in.
fascinating-
I want to keep the viewer up to speed just so they know what's going on here in this room. They are talking about trade. Trade being a very big issue, obviously, out there on the campaign trail. Art Laffer, you know, Donald Trump has repeatedly been calling for a fairer form of trade, that it's not fair, effectively, when we send our goods to China or to Mexico, and we don't charge a tariff, yet they charge a tariff on our stuff that comes into their countries. So that one can anticipate is going to be a big topic of discussion. How much do you think that influences the Fed, if at all?
I don't know if it influences the Fed at all. It influences me, though, Trish. I mean, we want free trade. We want as much free trade as we can. The more trade with foreigners, the better off it is. Now, what Donald Trump has said time and time again is that he believes in trade. He believes in free trade, but he doesn't believe in the trade agreements, which are very biased, badly written documents. Now, I would vote for TPP if I were a congressperson, But it's a very badly written document and really should have been done better beforehand.
Yeah, a complicated one, and trade is not an issue that necessarily comes so easy to some of those political types. You know, we saw this, of course, with healthcare reform as well. Another very sophisticated, complicated topic that got messed up along the way. Jay, you started the Emerging Markets Group at Morgan Stanley. You have been very active in these overseas markets. When you hear some of the rhetoric from Donald Trump right now, and he talks about a 35% tariff potentially on incoming goods, what does it make you worried, or do you think that this is just, you know, what he's saying from a deal standpoint? I mean, you have to negotiate from something.
Sure. Well, I think when you think about Donald Trump, you think about negotiator as one of the key things that he is. So he's going to reopen these deals, and he's going to try to get a better deal and say that he got a better deal. And he probably will be able to do so to a limited extent, given the size and importance of our domestic market relative to other countries. However, I think it's also important to note that his policy mix, if gone wrong, leads to a sharply stronger dollar, which is negative for our trade balance. And if you just think about Mexico, for example, he said a lot about Mexico, but in effect, his election has led to a 20% depreciation of the Mexican peso over the last 6 months, and that in turn has made Mexico 20% more competitive. So I think we have to be aware of the implications of a policy mix that gets too hot, too overheated, versus a policy mix
well, you know,
that doesn't
I got to go back to Art on this, because Art, you're a big fan of the strong dollar. Just like you said, hey, you'll take all the tax cuts you can possibly get. I know that you like a strong dollar as well. So how do you counteract Jay's point? He's concerned about U.S. competitiveness if our, you know, cost of goods is that much higher because of dollars and the depreciation in all these other currencies, and you get a Fed that's in this interest rate rising environment. What does that do to our ability to compete?
I think a strong dollar is very good for the U.S. What I think it symbolizes is foreigners trying to invest in the United States. And just remember, the U.S. capital surplus is one and the same as the trade deficit. If you look at what happened in the first 6 years of Reagan, the dollar doubled in value in the foreign exchange markets, adjusted for inflation. The U.S. trade deficit increased dramatically. The U.S. capital deficit, capital surplus increased dramatically. We had the biggest boom in U.S. history. Why not do it again? Let's just go for the gold.
Because we're in a totally different situation.
Reagan.
You can't go.
No,
you
it's
can't
not.
do it
it's
again.
Exactly the same.
You're heavily indebted.
We've had our country
Interest
run
rates
into the
are at the
ground by
lowest
these
levels
fuzzy
in
wuzzies.
decade, and the dollar's at the strongest point in 3 years. There's very little that's similar to the Reagan years. I'm sorry. Very little.
It can get a lot stronger. And if we just make the U.S. the preferred place for investment, you'll see the dollar getting stronger, and you'll see capital flowing in, which means a trade deficit.
Yeah, you know, by making the U.S. that much more attractive, in other words, you're talking less regulation. If you go to Mexico right now, it's a lot easier to open a factory. You don't have to deal with all the EPA headaches, shall we say, that you're going to deal with here. And you also have a better, more favorable tax scenario. So the goal is, as I understand it, from your way of thinking, both Brian and Art would agree with this, we become more competitive by creating a more hospitable environment for business. And shouldn't that translate into growth? Jay, I don't understand why you disagree with that so much.
Well, I think it's pretty simple. People want to come here because of our domestic market, not because we're less regulated or more regulated. What we have to offer
Don't we want American companies here too? Don't you want American companies wanting to stay here?
And I think they are. And you know, Trish, that I'm a big believer in regional integration, right? I think that's the way the global economy grows. So I think there is an opportunity here. All I'm saying is that we have to be aware of the fact that a stronger dollar is not good for our trade picture. And if we want to grow the economy, we have to be careful about doing fiscal spending to a limited nature, which doesn't spook the bond market, because the bond market has the ability to destroy the whole process by leading us into
in other words,
a
interest rates get
recession and a
just
stock market
so
crash.
high that it runs away from you. Go ahead. I think is that Brian?
Yeah, that's me. You know, if Mexico had a good monetary policy, good tax policy, good regulatory policy, and good spending policy, the peso would not have weakened relative to the dollar. And so the reason the dollar's up is because we're going to have a better set of policies.
Yeah,
and
but
this
Brian,
idea that people
Brian.
don't come to the United States to invent stuff? What are you kidding? I mean, 30–40% of all our companies are done by immigrants. And so they come here, they get educated here, they invent here. We drive the world's entrepreneurship.
Okay.
And it's going to happen better, I think, under a better set of policies.
We certainly do. We are the center of innovation, and I think we're going to continue to hold that title. We need to actively work, though, to hold that title by creating the most hospitable environment.
Exactly.
Kimberly, I think you were trying to jump in. Go ahead.
Actually,
Yeah,
it was Liz. Go ahead.
Kimberly Fox.
I was just saying, I just segued on that. It is the backbone of this country is our small business, our entrepreneurs, and that's what's made this country great. I'm hearing from my investors. I got one small business owner, a client that said basically after this Trump won, it's like the clouds of stagnation have parted and the sunshine of economic growth is now shining down on the markets. That's what he said. There is so
Yeah.
there is
I love hearing that.
optimism.
I do think, Liz, there's more optimism in general out there, right? I mean, the markets don't lie. The fact that, we're down right now, 52, but the fact that we're so close to 20,000 shows you that there's a belief in something better happening.
It also shows you that people listen to the Fed, and I can't believe my good friend Brian Westbury says that the average American shouldn't know who the Federal Reserve Chief is. Why not, Brian? The Federal Reserve controls eventually what people pay for their car loans, what kind of return they're getting in their savings accounts. People need to know what is happening at the Fed.
Yeah, Liz, I exactly believe that you're saying what people truly believe, but it's not true. We would operate perfectly fine without a Federal Reserve. In fact, the United States grew from a nothing backward colony to one of the greatest superpowers in the world in 1913, and we never had a Fed, ever. And since we have had a Fed, we've had nothing but inflationary problems. We've had bubbles. We've had collapses that you can directly tie the Federal Reserve to. And we've become people count. It's almost like they want a parent or something. You control this. Don't let the market. I trust the markets. I don't trust
so do I,
12
Brian.
people sitting around the table.
I'm not saying I do, but this is what we've got at the moment. You said we don't even need to know who the Federal Reserve Chief is, and they shouldn't.
Right.
What we've got is this system, and for now, we need to know what they're doing.
Well, here's an interesting point. Let me jump in with this.
Liz, I do want to agree with that statement right there, Liz. You're absolutely right. I was not saying that we're wasting our time doing this. I'm just wishing for a better world where we didn't know who the Fed was.
No, I hear you. And people,
rates.
they should be educated about what's going on in the financial world. That said,
right.
I kind of hear you on this one.